Welcome back to Market on Close. We have just a few minutes left in the trading day. That, of course, means it's time for our big picture panel. So we'll bring in our team from Charles Schwab. Joining us today, Kevin Gordon, Senior Investment Strategist, and Michelle Gibley, the Director of International Research at Charles Schwab. Kevin, let's start with you. We got this jobs report on Friday. We saw the massive sell-off. It obviously was disappointing, but is it an overreaction to just one bad print?
Well, it's tough to even characterize Friday as that much of an overreaction. I know, the market decline relative to what we've been used to over the past month or two was pretty significant, but there was an improvement in breadth throughout the day. You didn't have as much of a deep sell-off when it comes to the number of stocks in an index like the S&P or even the broader, NYSE, the number of stocks that were selling off. So it wasn't an overreaction as much in that sense. But I do think that it does call into question maybe some of the strength or the resilience that's been in labor over the past several months. Not that I think that it's indicative of the labor market completely falling apart, because there are still other indicators like initial jobless claims, probably most importantly, that don't necessarily corroborate, some of the weakness and the degree of the slowdown that you saw in non-farm payrolls. But at the same time, I think that in aggregate, from May to July, what we've learned so far from, data coming from the BLS, in particular from the jobs report, is that we are in a little bit of a frozen state when it comes to the labor market. There is this pretty significant catch down on the supply side. There's a pretty significant move down in the demand side. That I think is almost emblematic perfectly to a degree of where we are in terms of how policy has been affecting the economy and in particular has been affecting labor.
And we had a guest on the show recently who made a comparison to 2020, 2021. Do you think that has any basis to it?
In terms of the economy, we're in a completely different spot. I think if you were going to translate it over to the market, if that's what the guest was in particular, referencing, I think that there are some similarities in terms of, the more speculative, riskier parts of the market that have really taken off. The meme trade has sort of come back into focus over the past couple of weeks, but the degree of the returns in some of those names is still very much not like we saw in 20 or 21. And I think that the monetary backdrop is also an important factor here, because in that era, a few years ago, we were at zero rates and you had a lot more fiscal stimulus going into the economy. That's clearly not the case right now. So it would suggest that you would need to see a much sort of stronger move in some of those riskier corners of the market and really see them overtake what is thought of as, the more traditional market. But I don't really see that being the case right now. So far, breadth is holding up relatively well, even though you did hit a bit of a stumble at the end of last week. But I think that, moving from here, looking for any sort of negative divergence where, the cap-weighted indexes continue to do better, but you had a little bit more of a deterioration in breadth under the surface, that would be more of a worrisome signal, especially because sentiment's gotten, relatively, frothy or stretched or optimistic lately. But again, nothing that you saw sort of similar to the end of 21, where it was definitely more of that negative divergence, ultimately leading you into a bear market in 22.
And Michelle, I want to come to you now about tariffs. We've gotten some more tariff news, some positive, some framework, some more uncertainty. Let's start with India and this 50% doubled tariff that they now have over the purchase of Russian oil. What are your takeaways there? We sort of knew it was coming. We just didn't know the number.
Yeah, I would say that tariff policy is still evolving, and we really don't have a lot of resolution. We have some resolution. And that's, again, evidenced by that 50% tariff on India today. Months ago, India thought they were at the front of the line for a deal. So this is really quite disappointing. 25% last week was disappointing. Another 25% today, another disappointment. Now, if India stopped buying Russian oil, which is the justification for the extra 25% today, that would imply fewer barrels into the global market and higher oil prices. But the offset is that OPEC Plus is continuing to increase production. We saw that over the weekend. And then there's hope that increased pressure on Russia could bring a peace deal that eventually boosts oil supply. For India, they've been more reliant on foreign direct investment for growth. And so higher tariffs could really hinder their growth. And it's a reason that they would like to get a lower rate.
And also we were seeing reports today of the Swiss president leaving Washington without any adjustment to a lower tariff rate. I think they were standing at 39%. Takeaways there as we're now watching people walk away from the table when most of the conversations have either led to an extension or some kind of framework in place?
Yeah, the new reciprocal tariffs go into effect tomorrow, but there's still, unsettled things like you mentioned for Switzerland. Mexico got a 90-day tariff truce at the end of July. China is likely to get another extension past August 12th, and we have sector-specific tariffs for semiconductors and pharmaceuticals forthcoming. We don't know. That could be any day. We still have a legal challenge to the use of emergency authority. And so there's still uncertainty about where things will end up. Canada and Switzerland are both among the larger trade partners that would like to get deals with lower tariffs. Now, last week's executive order said that the new tariffs don't apply if countries are in negotiations with the U.S. So we'll see what that means for Switzerland. China appears to be making out better than expected, which is kind of a surprise.
Yeah, and then let's talk about China. It is interesting enough. We're starting to see, more and more reports of that. Many may just keep manufacturing in China because they are faring a little bit better than expected.
Yeah, I mean, it's, a little bit of a surprise. It seems to be, initially we felt like China was really the target, and I think they still are for this new tariff regime. But so far, the new tariff there is an extra 30%. And if you add that to the 11%, 12% they were at the beginning of the year, they're still roughly in line with the new 40% transshipment rate for goods rerouted from China through other Asian countries like Vietnam before coming to the U.S. And of course, 42% for China is below the 50% rate on Indian goods right now. And, China's supply chain depth and logistics efficiency are really second to none. But this does extend some uncertainty for manufacturers. They could continue to stay in China for now, but they still have uncertainty about the future in terms of, where they're going to be doing hiring, where they're going to be spending CapEx. So, we're still a little bit of a wait and see right now.
Yeah, and we'll continue to be in the wait and see indefinitely. And I'm sure we'll talk again about tariffs as more frameworks come out. But thank you, both of you, Kevin Gordon and Michelle Gibley. We appreciate it. Our team at Charles Schwab.